You want to intersect your highs and lows with 1x1 or 45-degree angles, 1x2s, 1x4s, and the traditional 30-degree, 45, 60-degree angles. You can also use circular arcs to project targets. Also, I'll throw in this concept of time cycles, scalping, because scalping techniques are really short-term trades where you're looking for a base that's been basing for quite a considerable time to break out, and there'll be a very short-term trade where you can jump in and jump out. There will also be times when you have quick reversals from a moving average where you'll scalp and jump in and out. So I throw these under the time cycle concepts, and we'll examine some of those coming up now. Now, we've demonstrated previously how you can take the signal reversal bar here, and you can take its length and double it again and double it, and get these potential targets. But ideally, there is always a time and a price projection. So if we have these levels on here that are important for prices, we can then draw a pure 45-degree angle. This is not adjusted. It is a regular 45, because what we want to do is we want to square this vertical distance. So where the 45 intersects the level, that would be a square. And then when the 45 intersects the next level, that too is a square. Or the 45 intersects the next level, that too is a square. A square meaning a vertical distance moved up and a horizontal time distance moved over. And at those times, we get reversals. So often we can buy a market and expect it not to top out until we get to our turning point. Now here there was a little inversion. In theory, this area, although it was a low here on support, so you would buy it, but in theory this is like a high, and it goes down until the next turning point. And this was much easier to trade because you identified a cyclic turn and you're approaching a support level and an angle. And so this would be a buy, and then it would go up to the next cyclic turn, which would be a high again. And here again we got a slight inversion, but from the last cycle we can see it should be a theoretical high cycle. Then we go down. This one we don't know as yet if it's going to be a low and turn up or not. When it breaks away, we can clearly see it's a midpoint cycle. And as it comes down to our major 50% support, we can count our 1, 2, 3, 4, 5 waves down. We're looking for a potential low, and the cycle gives us an added confirmation. Since the prior cycle was a high, this cycle turn down here gives us added input that it's probably a low and would encourage us to buy it or buy it breaking away from this point. These time and price targets are done on all time periods. The last one was a very short-term period. This is a weekly period. And so again, we take the weekly chart, we double that, we double it again, we double it again, and we see it works fairly well in giving us targets. Our 45-degree trend line comes up and indicates there'll be a turn somewhere right in here, and we see the bars have been going up. And it turns out it is a short-term top. There is a big plunging bar right after that, but it's only for a week or so. And then it comes up and we get the top at our resistance number, and then it comes down for 3 to 4 weeks where we expect a cycle turn, and that's a low for a 2 or 3 week rally. Then we have a major low down here, and it's going up into a cycle turn, so that kind of warns us there may be a correction coming, and it does last for 3 or 4 bars. We have another big rally, and so even though this is a very strong uptrend and most of these are top and top and top, it does warn us at these cyclical turning points that there could be a correction of at least a couple of weeks or so. And at the end here, of course, we get the big reversal spike, big island reversal basically. Then it comes down and breaks our trend line and breaks our key primary resistance doubling area, and we get the biggest correction we've seen at that point. But tying in the time along with the support and resistance numbers give us a lot of added information. When we talk about projections, we can also take a prior swing and try and take projected points off the axis of that swing to get a probable future objective. Here we have a weekly chart of Disney, and I've drawn a straight line from the prior decline from the high to the low, and I found the midpoint with the simple retracement tool. I found the midpoint along that average line, and here I'm using a 30-degree advancing angle and from the bottom I use a steeper 60-degree advancing angle, and they converge in this area. The intersection gives us the potential price target. There's still a chance on this particular convergence that they could go out another month or so from this chart one more time. But from the low here, when we make this projection, it does a reasonably good job of saying, okay, this would be our target area. If we are buying down in here and we're going to buy dips for a while, this might be the area to look for some kind of a culmination. Besides using the offset traditional angles, the 30, 45s, and 60s, we can use the geometric angles. And in particular, here we show an example of a steep 1x2 or 63 3/4 degree angle coming off the top. And we have coming off the bottom a less steep 2x1, 26 3/4 degree angle. And where they intersect approximates an area where we could expect the low. And also we'd throw in probably our 50% retracement would fall in there too. But the purpose of the projections is when we're at this point over here to give a rough idea how much more time we have to go before we can look to buy and how much more in price we have to go. So it gives us a quick and dirty idea that, okay, let's not buy it over here, buy it over here, buy it right here. We still have to get into this time period over here before we can expect it to be done with the correction. And then we can look for some chance for a technical buy signal to go long. We can also get some projections off our grid angles. We can use our 45-degree angle, which kind of points to the primary trend. And if we have a grid box in that's fairly scaled, stepping back from it and getting a bigger perspective, we can see that they usually gravitate towards the middle of it. And they'll either do the big turns at the 3/4 points or on the corners. Here we had a little of each. It made a low along the bottom at the 3/4 point, had a little rally, and then failed, and looks like it could have made its final low just past the corner point. But when you're over in this area over in here, let's say, and you put on a bigger grid, you might be able to say, okay, the overall grid could be this big time period in length before the overall pattern is done. And at the 50%, we can take a look at it and see, does it turn up from the 50% of the grid or does it turn down? And that will probably forecast the second half of the move and give us some added information of when we have to expect a trade. Circular arcs are often used with very good and accurate results, but here again you need a scaled chart. You have to experiment with some arcs to see if they work. If they do work, then on that particular chart you continue to use them. If they're not working very well, you'll have to rescale it or go on to another one. But for instance, from this high, we go down to a low, and this one comes out here. You could also have a secondary low over here that would give you a secondary arc that comes up through here. But I get more conservative and use the first one first because that will give you the first top if there is one. Sometimes you'll get a top and a secondary one. Sometimes this would be a lower top, and the other arc in here will give you a higher one. Then after we get the top, I draw an arc from that point down to the preceding points of the chart, and that one comes around through here and starts to turn up. Could have been the horizontal, could have been our low down here, but this one gives us a rough idea of how big a decline we could expect and where the bottom might very well turn up. Early on in this video, I emphasized you don't want to short the highs. You want to short stocks that are in downtrends, because when you short the highs, the vast majority of people actually buy breakouts, and they always train themselves to buy new highs, especially on the daily charts. So this gives rise to a scalping technique. Here on the 60-minute E-mini, every time you run, now this is a long-term uptrend, so each of these spikes here would have been a new high for the year. So at this point, you're running the stops basically. You may be going up dramatically more, but at least you're going to run the stops. So sometimes you want to anticipate that, maybe at the halfway point of the bar. As you approach it, you make an entry. And note here, it works almost every single time. Some are very big, and this is a big mover of 10 points or more. But note, in many cases, it only lasts a single bar or two before it goes down, showing that it was just running the stops. So it is a scalping technique to get in and get out. Often you might not know when this big bar is going to go, so you'll often have a buy stop here and a market if touched, and you can have a sell right above it. So you're slingshot into the trade and right out of the trade with a reasonable profit, and you don't stick around to find out if you could get any more. Since we see that many of these bars only last an hour or two before they go right back down again, but the overall trend does continue on up, maybe we can modify this idea and anticipate the eventual breakout. So the earliest anticipation would be where the signal bar gave the last sell signal. When you regain that level, perhaps an entry point in that area will give you more of a profit, having got the profit to here, and then you can hold here with the stop to see if it does push on through. Note too, by the way, we know now that the DNA is in this signal reversal bar. And note that in most cases, the correction is just one signal reverse bar down. There's two of these. So if you double this length, you see the overall correction was down here. So this might be a clue too as to an entry point. Just after a high is made, there'll be a pullback. And if you're in an ongoing bull trend, they'll come back and go out again. Here too, if you double this length, you'll probably get an area right in here. Here's a little tiny one, so you get a little tiny correction in here. Here's another one. If we doubled that, you get a correction expected down in here. This is the only one that had multiple legs down, and it was a big correction. And after a major correction, you had a much bigger rally. So there are different strategies we can employ, but basically when you're in an uptrend, they only give you a little breathing room for a day or three before they try and go to a new high for the year. Just like running the stops at the new highs for the year, the midpoints are very similar to that. When you have a breakdown and people are waiting to see if they have to buy again, especially going up to a new high, often when you hit that 50% point, they accelerate dramatically. So you could focus on scalping immediately long at the 50% and using a stop if there's follow through. If there's no follow through or if it hesitates, get in for one bar only and then jump out. On the way down, and notice after we got to a new high here, I continued this range up to the new high. So on the way down, this was half the range. When we broke that, they immediately accelerated down tremendously. So this could have been a big bar scalp. They never exceeded it on the upside again, so with a trailing stop, you would have made money. But the purpose is to scalp the breakdown area from here down to here. And we see over here that was probably 6 or 7 S&P points in that one bar. Over in here, there was a failure. You got to the 50%. It spiked up a little and came down, indicating, again, perhaps a strategy of being long in here, only one bar only with a stop. Again, over here, same type of pattern. Broke out, hesitated for a bar or two, drifted down. Eventually, when they broke out, they really moved. But on a scalping basis, remember, this is a timing trade, so you only want to be in it for a bar or so. And then you want to see big momentum develop. If the big momentum doesn't develop, the scalp is not a good scalp. You want to get in and you want to get out. I also demonstrated much earlier the fan angles. And here again, a fan angle. And note that they're all pointing upwards. So this is an uptrend. And basically, good habits tell us don't be short uptrends. You just want to buy the dips in an uptrend, sell at resistance, and rebuy. That's the best habit. Now, of course, on a 5-minute or 15-minute E-mini chart, you will be going short as much as you're long, probably half the time. And I would also emphasize that if you're day trading E-minis, these things are meant to be traded 7, 10, 20 times a day. These are not a buy and hold vehicle, even though they have leverage. You jump in and you jump out, and you can go short because you're not going to hold them more than 3 or 4 or 5 bars. But when you're talking about stocks and longer-term trading, when you're in an uptrend, it's best always to buy on an angle and immediately just sell out when you hit a upper angle, and then wait to regroup either at the angles. And then as soon as they go up and touch an angle, you sell out. Then you patiently wait. If it doesn't work, you have to sell out, wait again, regroup. So you're constantly just repositioning. That's all you're doing against these angles. You're assuming the trend is up. You're going to buy at an angle, sell against an angle, but not go short on the angle.